Why Metro Atlanta is ground zero for institutional investors. If you live in Metro Atlanta, you're already in the middle of it. Wall Street owns more of your neighborhood than you actually think. And it didn't just start last year. It started on the courthouse steps back in 2008 through 2012. I work with buyers and investors across North Metro Atlanta every single day, and in this video, I'm going to walk you through why this region has become the epicenter for institutional real estate ownership in the entire country. We're talking about counties like Clayton, Rockdale, Henry, DeKalb, and Douglas, all five at the very top nationally for the highest share of single-family homes owned by large investors. Not Phoenix, not Tampa, Atlanta. So while national headlines say institutional buyers only own about 1% of homes in the U.S., that stat hides the real story because here in Atlanta, Metro Atlanta, it's not 1%. In some counties, it's pushing 10%. That affects home prices. That affects rents. That affects whether your family builds wealth or they're stuck renting for the rest of their lives. You become a renter nation, a renter county. And with many of these same institutional players now quietly pulling back, there's a new set of risks. Falling demand, compressed values, neighborhoods that will shift, and they will shift fast. So here's what we're going to break down. What does the data actually say about who owns what? How is this wave of investor activity started in Atlanta? The real impact of affordability and community ownership, and what buyers, sellers, and investors need to watch out for right now. Let's start with the most misunderstood stat in housing today. Institutional investors, defined here as owners of 100 plus or more single-family homes, nationwide own less than 1% of the total single-family housing stock across the country. That's the national average. But it's meaningless average if you live here in Metro Atlanta, because in counties like Clayton, Rockdale, and Henry, institutional ownership isn't 1%. It's 8, 9, or even 10% or higher. That's nearly 1 in every 10 homes in the some zip codes that are owned by institutional investors. This level of concentration just doesn't skew the numbers. It reshapes entire housing ecosystems. And Atlanta isn't alone. You see similar patterns in Phoenix, Tampa, Charlotte, and other Sunbelt metros. But none are as top-heavy as Atlanta. In fact, the top 5 counties in the country for institutional ownerships are all here in Metro Atlanta. This is where single-family rental industry scaled first. It's where the infrastructure was built, property managers, contractor networks, and leasing systems that can handle thousands of homes all at once. And the roots, they go back over a decade and a half. Go back to 2008. Foreclosures, they hit hard. Georgia's fast-track foreclosure process allowed thousands of homes to hit the auction block on the first Tuesday of every month. It's called Super Tuesday. Firms like Blackstone and Colony Capital rolled into town with cashier's checks and Wall Street backing. They had funds to buy. They bought hundreds of homes in one day at a time, every single Tuesday, the first Tuesday of the month. Courthouse steps in Gwinnett, DeKalb, and Clayton were flooded with deals. It was chaos, organized chaos, but it was chaos with institutional money leading the charge. I was there. I saw it firsthand. And once these homes were acquired, the systems were built. Maintenance crews, rent collection platforms, inspection processes, leasing workflows. That's how Atlanta went from distressed asset cleanup to build to rent goldmine. Today, companies like Invitation Homes, Progress Residential, and AMH have institutionalized what started as a distressed asset play. They built local portfolios that rival traditional property management companies, except they operate on a national scale. And that scale gives them both influence and leverage. Let's talk about the ripple effect. First of all, pricing. Institutional demands tend to drive prices up. That makes sense. More demand, higher price. These buyers aren't emotional. They follow yield. They don't care about how the family grows up. They don't care about who was raised in this particular home. They'll buy 20 homes in a neighborhood that check the boxes for size, age, school district, and projected rent. That kind of volume can lift comps and push up median sale prices. Next, affordability. As purchase prices rise, so do rents. Remember, institutional buyers aren't reselling, they're holding, and they're holding for long term. So they price rent to match the return thresholds. And when inventory is tight, tenants have few alternatives. Then there's the impact on owner occupancy. In some communities, ownership rates fall sharply as more homes are bought by funds and converted into rentals. This erodes pathway to wealth building, which has been the traditional way to build wealth in America, especially for first-time home buyers. It also changes the character of our neighborhoods. Fewer long-term residents, more turnover, and in some cases, less local engagement. Finally, vulnerability. If some of these same institutions start selling off assets, as many are doing in 2025, it puts downward pressure on values, especially in areas where they hold large percentage of the inventory. This can hurt existing owners' equity and destabilize the very neighborhoods they helped reshape. If you're a buyer in Metro Atlanta, pay attention to the zip code trends. Know where institutional ownership is concentrated. High concentration can mean less competition from other buyers, but more volatility if those funds pull back. If you're a seller, you may be competing with bulk purchasers or bulk sellers. That affects pricing strategy, especially in neighborhoods where investors have dominated. And if you're a small investor, understand that institutional players often have different goals. They may exit certain areas that no longer meet yield standards. That could create buying opportunities or signal a shift in fundamentals. And if you're a professional in this market, an agent, lender, property manager, the data you need to know it cold, because your clients will start asking on a regular basis, and the people who can answer with clarity, they will win business. So what's next for the outlook of Metro Atlanta? 7 of the 8 largest institutional single-family investors were net sellers in Q2 of 2025. Rising interest rates have cooled returns, although we're starting to see interest rates trend down a little bit. Capital is still getting tighter, and while build-to-rent communities in select pockets, the bulk buying frenzy of 2021 and 2022, that's past. But here's what remains: an entire local housing ecosystem shaped by over a decade of institutional influence. Infrastructure that makes Atlanta uniquely positioned for the next wave of single-family rentals or build-to-rent activity. And communities that are more exposed to institutional movements up or down than anywhere else in the country. As a mortgage professional here in Metro Atlanta, I see the impact on a daily basis. And my job is to help clients navigate this new landscape with eyes wide open. If you're thinking about buying, you're thinking about selling, or thinking about investing, know who you're competing with. Hire a professional. Know how these dynamics shape your upside, and get clear guidance rooted in real market data, not national headlines. If you found this interesting, you found this helpful, you found you didn't get anything at all, do me a favor, share, drop a comment, and let somebody know to subscribe and get updates on the Atlanta housing market. We'll keep bringing you the numbers and context and the clarity you won't find anywhere else. Let's get to work, and that, my friends, is guaranteed.